Welcome to episode 8 of the Cash Flow Connections podcast. The topic for today is highlighting operational management of multifamily apartments. As passive investors, we usually receive pro formas from sponsors that include line items like admin fees, telephones, pest control, stuff like that. But it is very rare that we really dig deep into each one of these line items. For example, I don't think I'm alone if I admit that I have never asked a sponsor how frequently they plan on having pest control companies sweep the property. However, if you have a team that has the ability to identify mismanagement on these line items and fully optimize each one of these expenses, the results can be spectacular for your portfolio, especially over the long term. So today, we're going to talk about some of the lesser known operational management components of investing in multifamily. Also, I want to mention that our guest happens to work for a real estate firm that is very private with their information. The guest is a friend of mine, so he agreed to do the interview as a favor, but you'll hear he's hesitant to give specific examples out of respect for the company's policy. But having said that, these guys know what they're talking about. They have taken many properties full cycle and are very well positioned for the future. Also, I guarantee you're going to hear a few insights you have never thought of before. So let's get straight to the conversation. How's it going, everyone? Our guest today is Nikhil Nadhani, who oversees the asset management division at a privately owned real estate investment firm. Founded on the philosophy of value investing, the company focuses on value-add opportunities and low-income housing assets. They target distressed situations whereby significant value can be unlocked through renovations or a hands-on approach to the operations of the property. Prior to this, Nikhil worked at another privately owned value-add investment firm for 6.5 years, starting off as an analyst and working his way up into the asset manager position. Before Nikhil left, he was managing the day-to-day operations of a portfolio of more than 5,000 units across several regions around the country. So Nikhil, really glad to have you on the program today. Thanks a lot for coming on.
Thank you so much for having me. It's an honor to be here today.
Tell us a little bit more about your background and how you really got started and interested in real estate in the first place.
I first started with my interest actually in business finance, stocks and bonds in particular. I went to USC. I graduated with business finance degree and then had a minor in music recording. So real estate definitely was not on my radar at the time. But I graduated in 2008, which is obviously when the stock market crashed. Job opportunities at the time were not very high in that business of stocks and bonds. So I basically, started applying to any analyst positions at real estate firms, not knowing anything about the business. Started off really well. After my first year, I fell in love with it because there were certain things about real estate that I noticed and learned that I didn't know about previously, and something that you don't see in the stock market. And it's basically the blend of your ability to use creativity, whether it's to rehab a property or redesign a property or to reposition it, as well as the analytical side of seeing how that effectuates change on the financial side of a property. So in my mind, it's sort of like an art and a science, and it really, attracted me to the industry. And ever since then, I've been in real estate, particularly in multifamily.
Cool. Do you remember the first real estate transaction you worked on?
Yeah, it was as an analyst. I was working on a joint venture with the company at the time, absorbing a portfolio of assets across the country. It was over 8 states, around 2,000 to 3,000 units at the time. And it was my first exposure to real estate and different regions and how they all operate differently and the specific nuances of these properties. It was a real challenge at the time to absorb such a portfolio for a small-sized company, but it was definitely a great learning experience.
Awesome. In the introduction there, you mentioned the combination of the art and the science. I think that's a brilliant way of putting it, especially when it comes to commercial, where there's all these complexities of the asset class. So your background is mostly in multifamily. Do you have experience in other type of real estate besides multifamily as well, or has it mostly been multifamily?
It is primarily multifamily. That's what I've worked in, and I actually love that asset class. Just like I said, your ability to effectuate change in a short-term horizon with a long-term goal. And I can give you an example of that. Sometimes when you take over a property that's distressed or let's use occupancies, for example, at 90% occupancy, in this relatively short time, you can reposition the asset by controlling the leasing rents, leasing at certain points where you know that you can get the occupancy back up to 100% or 98%, and really turn that asset around. Just an example of like a short-term, strategy for a long-term goal, and then manage it from there going home. And then you can also track every change as well as see the overall impact it has on the asset during that time. If it doesn't work, for example, you can make adjustments along the way. So that's what I really like about multifamily. You're not locked in for long term, with industrial or retail. They're long-term leases attached to it. With multifamily, it's residents on 1-year lease contracts, and they move in and out all the time. So you have an ability to make those adjustments as these people move in and out.
Yeah, that's a good point. And so within the multifamily space, give me an idea of what y'all focus on in terms of maybe purchase price or what particular markets or what particular income level you guys target.
So, the current job that I'm currently at, it's more of an affordable, and that's our strategy. I mean, we're opportunistic real estate investors, so we look across the country, but an area that we've seen a lot of opportunity just because the fundamentals make sense in terms of price as well as operational inefficiencies is affordable housing, and it's become one of our major business strategies and a growing pipeline for us.
Give us a little bit of context. And when you say affordable, what does that mean in this sense?
So affordable housing, what we're dealing with in particular, the type of affordable housing is primarily involved with Section 8 contracts whereby the rents of the property are locked into a half contract. So that's housing assistance payment contracts. And there are different types of contracts which allow you to receive rent increases over time. And basically what it is, it's an agreement between the owner as well as the public housing authority for each unit on the property, ensuring that that property and that unit is occupied by a qualified voucher participant. And what I mean by that is when you have a prospective resident that qualifies under certain income guidelines, the average median income for that region, state, which allow them to live at the property and have a portion of the rent subsidized by HUD. And that's our agreement with the housing development.
Got it. And what's your major day-to-day function at the company you work for?
So my major function is not only day-to-day operations, but just managing the portfolio and ensuring that it's performing to our, expectations. So we monitor everything from the performance of the asset as well as, transitioning assets into the portfolio and turning them around if they're distressed, or just achieving operational goals. We obviously are cash flow driven, and that's what we look for. And the beauty of these type of properties is that they are recession resistant because the income is tied to a half contract. So therefore, the rents don't change. It's an agreement with the federal government, and that's the income that you get over time.
Yeah, that's a really great market to be in. In fact, we had someone recently on the program by the name of Jason Post, who was talking about something similar in the affordable context. There's a lot of mismanagement, and there's an opportunity there to depend on government contracts, which basically, the word guaranteed is not frequently used in real estate, but it's just about as guaranteed as you can get in this game. So, what are some of the nuts and bolts of this episode today is going to be on really operational mismanagement, how to identify and how to effectuate change, as you put it, in the multifamily space. So what are some of the items you look for when you're trying to identify if a property is significantly mismanaged?
To start off, it's very important to understand that every property has specific nuances to it. I believe that every property is relatively different. They're all in the same space, but they have specific nuances that you need to learn about, and you can only learn about them after you acquire them or through the due diligence phase. But the type of multifamily asset matters as well. We obviously have affordable that we just talked about, but there's also the conventional side. So I'm going to go through an example of each just to give you a feel of, the difference between the two. But the first and foremost thing, that I do obviously is when I get to a property is interview the staff and get a feel for what they're doing. Staffing is probably the most important factor in any operational risk management because they're the ones driving the property. They're the ones making the decisions. And those decisions affect the performance of the property. So not only interviewing the staff, but then asking them questions, after doing a due diligence on financial statements, and then seeing how their responses drive the financials. That gives you an idea of how the property is being operated. And going back to what I said, focusing on their decision making and how they make decisions and how it affects the financial statement, which at the end of the day will affect the cash flow for the property. So to give you an example, we'll start off on the income side because that's obviously one of the most important sides, depending on what type of property it is. If it's a conventional property, you're looking at occupancy and availability on the property versus their leasing rents, right? So a great example of this and a basic example of this, I've been to properties where the manager is very excited and very happy that they're running at 100% occupancy, which is great. And, I would be too. But if you look at it from a bigger picture and you look at where they're leasing at, if they're leasing at their effective rents at 100% occupancy, you're basically driving no growth at the property. And by effective rent, I mean the weighted average rent on the property. So the average rent that an individual or resident pays at the property. So, for example, if a property is at 100%, let's say the effective rent is $500 and you're leasing at $500, there's no growth that's coming on the rental side for this property. The reason being is because you are at 100%, so you're capped at your occupancy, and you're not really looking to push rents. So that's a sign of mismanagement in the sense that, yes, the property is stable, but there's room for growth. So you should definitely look at your leasing rents and see if you can lease above effective rents, whether it be at 1%, 2%, 3%, depending on how the market and the local market comps are pricing themselves, to see if you have any room for growth. Sort of a takeaway, just a basic takeaway is if you're at 100% and you're not driving rents, you're sort of doing something wrong. Because even though you have stability, you're not really driving growth. And that's important too. You want your cash flow to grow over time. And that also comes from the income side. So you want to make sure that, you are driving rents, you are seeing growth on the income side. Technically, in my mind, you should never be at 100% on a conventional property just for that reason, because it probably means that you're not pushing your rent. Now, there are times where, you might be at 100% and you're leasing 5 or 10% above your effective rents, which is great, and that's where you want it to be. But you're always looking to drive your rents to a point where it sort of affects your occupancy and you maintain a higher occupancy range, but not necessarily 100%, if that makes sense. On the affordable side, it's a little different of a game. Like we talked about earlier, you are basically bound by a HAP contract, which means your rents are already fixed, they're locked in, they're in an agreement. Your whole goal at that point is operational efficiency and ensuring that these units are 100% occupied at all times. So it's two different examples of two different types of multifamily assets, one that's affordable, one that's conventional, and how they differ in your strategy and how you should approach them. On the expense side, what I do is I go through the financial statement line by line, and I try to make sense of every line item, whether it be, looking at telephones and seeing how much they spend on a monthly basis. Do they need 6 phone lines when there are 2 people in the office? Is there other reasons for that? And little items like that. The idea here is with every small item on the financial statement, it doesn't look like a big issue at the time because, it's a small item. It's either a telephone or an answering service or pest control or trash, and we'll get into those details. But small changes in every line item is going to make a large change on the property over time. And that's the idea when I talk about making small adjustments to effectuate change in the short term to achieve your long-term goals. This obviously goes all the way back to the beginning. Staffing is your number one and most important feature on your property. Are they efficient? Are they making the right decisions? Are they open to change and effectuating change? And then coming down to the overall execution. And that really drives a lot of these items. Apart from that, you can also look at things that it's not really controlled by the manager necessarily, but also by the owner of the property, and these are service contracts. What we've noticed on a lot of the deals that we take over, there's a lot of inefficiency on the service contract side, whether it's pest control and they're not renewing, they're on month to month on a pest control contract, and they're servicing the entire property on a monthly basis when, let's say, it's a Class A property and we don't have pest issues on the property. Is there really a need to service the property at such an extent, or can we get away with, servicing the property, a third of a property every month? It really depends on what's going on at the property, and what usually happens with a lot of ownerships in terms of inefficiencies, because they have a low cost basis and their returns are high regardless of what they're doing on the property, they can afford to go out there and just say service the whole property. It doesn't matter. but that's not necessarily what the property needs. And that's when it comes down to these nuances that I talk about, the type of property, the type of clientele, and what's going on. Another good example of this is trash. I've been on a property where the manager has been really happy to show that she has a clean property and there's no trash on the ground. But then when you walk the property, you see 20 trash dumpsters all over the property, and most of them are empty. It's great that the property looks, great, and there's nothing going on in terms of trash all over the property, but do we really need 20 dumpsters on the property? Probably not. And what we found in that situation, that we could have cut it in half and delivered the same aesthetics of the property, keeping it clean, and then saving significantly on the cost of trash removal. In general, service contracts are an area where you can get an immediate bang for your buck just by going through the contracts and getting an understanding of what is being serviced and what the property actually needs. And then the other part of it is, the idea of just having services on a month-to-month basis. A lot of owners sometimes get scared to lock into contracts after their contracts go month-to-month. There's a benefit to it as long as you know what you're doing. And I think those are areas where you can actually effectuate change, going back to, like I said in the beginning, in a very short-term horizon, almost immediate at that point, just by renegotiating a contract that's on month-to-month, and then watching how it affects the property on a long-term basis by saving you a lot more money than you would have thought.
Awesome. You mentioned several good examples there. It's interesting. Of the examples you mentioned 100% occupancy, pest control being too frequent, and trash control being too extensive, all of which, if you have a property as an owner, especially if you're at a low cost basis, like you mentioned, you think you're really killing the game. You think, everything's going well. The property isn't dirty. There isn't a pest control problem. We're at 100% occupancy. But what's interesting is that you can actually see that. You can see through the lines and really see through the what's behind the breakdown on Excel, and say they are spending way too much money to achieve the same goals that we can achieve. Right? I mean, it's very interesting.
Correct. Exactly. No, that's exactly it. And it goes back to how much attention you give to the property and understand what's going on. And like you said, you got to look through all these positive things that you talked about, being in a high occupancy, having a clean property. They're all positive, but can we do better? Can we do better, and where can we do it better? And that's what our focus is, and that's what I focus on, because there are a lot of properties that, perform well, but there's room for improvement. And then there's a lot of properties that don't perform well at all. And those are easier to look at because you already know that, your occupancy is low, there's a crime issue, there's a trash issue. Those are so straightforward to you because you know what's going on and you know how to achieve them. But once you've turned those areas around and the property is running perfect in that sense, you still got to look further and see if there's room for better management and better efficiencies. And that's when it comes down to those little, quarter turns or small adjustments as you go along to see if you can improve further. And it goes back to that whole theme that I was talking about in the beginning, short-term changes that you can adjust along the way and look at the long-term impact. And that always flows through your financial statement. So every decision you sort of make has an impact on your financial statement, which will affect your bottom line and then therefore your cash flow.
Right. So just for the listeners' sake, let's take a look at really what this has the potential to do. So what is your typical purchase price? What is the range of the purchase prices that you guys are looking at?
Not to get into too much detail, but our deals can go anywhere from a couple million to into the double digits, to be honest.
Okay. And so when you implement, let's say, pest control, trash, contract renewal, or some kind of tightening in terms of rents, how much value can you add to a property over that time period?
I can give you percentages on just those particular line items. The impact on the property will obviously depend on the purchase price and the value of the property, but the whole idea over here, it'll boost your NOI at the end of the day with operational changes. Just to go through a couple of examples, pest control, we usually see anywhere from 10 to 15% of savings just by looking at the needs of the property and what the pest control contract is currently doing. There's always room there, and it's usually in the scope. Sometimes there's price, but you don't want to get a really cheap pest control company with a great price, but they're not doing a good job. You want someone that can do a good job, but that's where you focus on controlling the scope. like I said in the, earlier on in the example, do we need to service the entire property every month if we don't have a pest control issue? Or can we cut it down to half, see how the property performs? If it's still not an issue, can we cut it down to a third? You still need pest control, but how much do you need? And that's the kind of thing. With trash, it's a lot more extensive in my experience. We've seen anywhere from 15 to 25%, even higher up to 40, 50%, depending on how the property is running. And most of that usually is driven through scope again. I mean, pricing is obviously something you can negotiate and bid out. And we bid out all our contracts to get the best price. We don't stick to a vendor just because he's someone's friend or he has a good relationship with the manager. We bid everything out, try to get the best price, and then we look at the scope. So trash cleanup and trash removal, there's a large variance of like what kind of discount or what kind of savings you can generate, which can have an impact on the property. But it goes back to the very beginning. If you keep making small adjustments at each of these line items, on some of them, there might be 5 or 10% savings. On others, like trash, it could be 20, 30% savings, even 40. At the end of the day, everything combined together is going to have a significant impact on expense reduction on the property, which will boost your overall NOI. Same concept with income. You can raise your rents by 1%, see how your leasing goes. If you continue to lease at the same rate, maintaining 100% occupancy, you push further. And usually it's better to be more aggressive in the front to see what type of impact it has when you're at a high occupancy. So if you're at 100%, go for it, 3 to 5% increases in rents and see if it goes even higher if the market bears it, and look at the impact it has on your occupancy. And those small changes combined with your expense reduction is going to boost your overall NOI.
Right. Yeah, that's great. So how quickly can you implement those strategies? How quickly upon purchase, how quickly do you find they're pretty much optimally efficient by the time that they're completely running the way you like to see them running?
Right. On the expense side, I think it's pretty much immediate, just because within the first 30 days, you can renegotiate all your contracts. You can implement policies on how maintenance is addressed, and what the staff is doing in-house versus being contracted out. That definitely, and before, I even say any of that, it all comes down to execution. So if you have the right staff who are on board and are following direction and taking your strategies and implementing them correctly, executing correctly, you can have immediate impact on a lot of these items, especially on the expense side. The income side, it's a little more of a nuance and there's more of a challenge because it takes time to see what type of changes you're making and how it's affecting your leasing or just how you're performing compared to the market. And I think that happens over time. So I think overall, to give you a time frame, we usually look at our deals, and to play it safe, within the first 6 to 12 months, we should have a property operating on an optimal basis. And this is all driven from staffing. If you have the wrong staff in place, that's going to drag your timeline out a little because you need to go find people that can do it correctly and can execute correctly. But once you have the right staff in place, it should be a lot easier for you to achieve your goals. But to be honest, it's usually 6 to 12 months before we take over a property and it is running optimally and efficiently to our expectation. Usually on the shorter end, we can usually get it done in 6 to 8, but then there are others that take longer, up to 12 months.
Wow, that's not what I was expecting, and that's awesome. That's it means you guys are getting in there very quickly. Sometimes it can take far longer, 2, 3, 4 times longer than that. 6 to 8 months is incredible, and with 12 months being on the longer end. So this is going to be a really interesting part of the conversation. You just mentioned execution is what this is all about, especially when you're really nitpicking and nickel and diming the best you can to make the opportunity perform as efficiently as possible. So how do you guys manage the execution of these strategies, given that these small changes make the biggest impact later down the road?
So we're hands-on with our property managers and the third-party management companies that we hire. So we work with third-party management companies across the country because our assets are all over the country. But we're very hands-on. So we're monitoring on a weekly basis, on a monthly basis, and a quarterly basis. We basically are talking to the teams on the ground, the boots on the ground, making sure our weekly on a weekly basis, they're following our instructions and strategies and they're implementing them correctly. And if they're not, then we're making adjustments immediately. On a transition, it's even closer because on the first month of 30 days of transition, we're pretty much involved in that process and we're making sure that, they're getting it done. And if not, we're making adjustments. That's how we maintain that timeline, and we try to tighten it as quickly as possible because we want to effectuate change as quickly as possible to get those returns up there rather than wait, out. And it all comes down to looking for the right staff, like I said earlier, as well as a management company. So we look at a management company with good systems in place, presence in the local area. They have relationships in the local area where they can pull resources to help us and have a similar approach to our management style. Once again, if they have all that, it's still at the end of the day, there's only so much you can learn from an interview and discussion. You can talk about strategies, but you're really not going to see how they execute until they're down there doing the work. And that's where it comes down to follow-up and just paying constant attention to what's going on. We follow up on a daily basis on some issues, and on others, we're willing to let it slide for weekly or monthly. But we have a set system of what we're trying to achieve on the property and how quickly, and then we prioritize what we want to go after first.
Interesting. So are you guys buying all over the nation, or are you focused on certain states?
All over the nation. We look at any deal anywhere, and if it makes sense to us, then we're basically going to go for it.
Okay, cool. And so that actually adds an extra component to this management protocol. So you mentioned earlier that you have priorities, you follow up on it every day on certain line items, but give us a little bit more detail about how you can actually keep an eye on property management companies spread theoretically all over the country.
Right. So, going with just the follow-up area, that's obviously talking about it and making sure that they've done it. But the way you really know that they've effectuated this change is looking at the financials, right? So within the first 30 days, your execution of strategies, if they've been put in place, you should see that flow through the financials and you should see that flow through the property statistics, whether it be occupancy, other income, expenses. I mean, if, going back to our examples, if we see a trash contract that is too high, too big of a scope, we've renegotiated and we've asked the property management company to implement it, you should see expense reduction in the next 30 days. So if the current contract was at $1,500 and you signed a contract for $750, you should see that hit the financial in 30 days. And that's just a basic example. And if they haven't done it correctly, if it's higher than $750, then you know they didn't implement it correctly. If it's exactly on the dot, you got your goal, and going forward, it should be at $750 going forward. And we eye that going forward. So when we look at our financial statements, we already know trash, for example, should be at $750 a month. It should never change. If it does change, or if there's a reason that something happened on the property and we got billed $900 that month, we want to know why, and we follow up. So we look at those financials in detail, line by line, every month, and then we look at our strategies, and we already know what changes are going to impact what line items, and we look out for that. So within 30 days, you will know what's going on, and that's how you keep a close eye on them and not just take their word for it, saying, hey, I've done whatever you guys have requested. We actually go there and we make sure that it's flowing through. And if not, we make adjustments. And that's from an analytical standpoint, just for operational changes that you do on a property. Everything should flow through unless it's a qualitative issue. Let's say it's a physical standpoint, then we fly out there. And if we're making changes to the physical aspect of the property or, the clientele on the property, we'll go out there, look at the files or look at the property and make sure those physical aspects and those aesthetics have been addressed as well.
Awesome. So that's great. So you have the front end, which is them confirming that they did this. Then you have the back end, which is actually seeing the dollars flow through the property in the manner that they should, making sure that those two line up with each other. And if they don't, you have a problem. If they really don't, you may need to replace somebody, essentially.
Correct.
Awesome. So after all this hard work, grooming each line item, just from an investor's perspective, this is interesting because we typically see a spreadsheet that says admin fee and that's it. And we don't have that. We don't go through each line item from pests to telephones. We don't typically know how many phone lines they have. So it's like, this is an extra level of detail that I think most investors are not familiar with, but it's providing a ton of insight into what's going on, especially with the experienced sponsors out there. So back to the question. So after all this hard work, grooming each line item, what type of value can you add to a typical property?
From looking at it from a general standpoint, obviously on the income, we're usually able to, on a conventional property, you are able to drive income if you're just looking at the nuances of the property, going back to like the occupancy, where you're leasing at, going into details of other income. Is the property charging late fees, what their late fee policy is? If it's a conventional property, what is your late fee policy compared to the other comps in the local area? And you go through every single line item like you talked about, just not the general other income. You're usually able to drive some sort of growth here and there. I mean, there are times where you might find a property that's running perfectly, but I mean, that's a rarity, and I don't think I've ever come across anything like that. But higher income obviously is where you're looking at by implementing those strategies. And then for the other side of the value is lower expenses immediately. You can sort of make those changes immediately, and then you drive lower expenses or expense reduction, higher efficiencies by having the right staff in place, and all those items, those categories that you were talking about earlier, you blend them all together, it's going to have a positive impact on your NOI and your cash flow, and you should see those changes not only on a short-term horizon like we talked about earlier, but even a long-term horizon as you make changes and adjustments as you go along.
Right. And over the long term, it adds tremendous value based on the purchase price, based on the number of units, based on the NOI. We're talking about hundreds of thousands, if not millions of dollars that can be added by just really implementing more effective operational standpoints, operational efficiencies, which is incredible.
Correct. And if you look at it from a portfolio perspective, it's crazy the amount of impact it can have on just positive impact on your NOI and cash flow. Because if you think about it, if you look at one property and you make the necessary adjustments, over time, things are going to be locked in. So your expenses get locked in, whether it's service contracts or the way you're approaching, unit turns or doing maintenance, whether it's in-house or contracting out, those things get locked in. And then you start making adjustments on your income side. And over time, that gets locked in on the way you're approaching your leasing or, getting your occupancy up, and you have the right staff in place. And as those things get locked in, it's like a cumulative impact on your property. And now if you take a portfolio of 20 properties, let's say, and you make all those changes across the board, whatever they are, and they all start having a cumulative impact on your portfolio as a whole, you're going to have the impact you're looking for. So it's those little changes rolling into your properties, rolling into your portfolio. And that's really it's not a glamour side of the business, but that's really where you're getting your impact.
Yeah, exactly. And I just to change asset classes significantly, I took a couple of sound design courses, and it's very similar in the fact that when you do mastering after the song has been produced, when you do mastering and production in the back end, in post-production, you're not supposed to make one big change that turns a song around completely. You're supposed to take tiny pieces of the song that you can barely tell the difference, but after you're done completely tweaking each little line item of the song, so to speak, the song sounds completely different. It's very similar in the fact that the small changes make a big difference. And with real estate, because it's traded on a multiple of income, the differences can be astounding over the long term. So that's a perfect explanation of it. And so for the closing questions, then let's talk about the negatives first. Have you made any mistakes in real estate? Any big mistakes, or is there anything that you wished you had done differently or learned earlier?
I think the biggest mistake, or something that I've learned from, and I wish I learned earlier, it goes back to the central theme of who drives all these changes is staffing. A mistake that I've definitely made in the past is holding on to the wrong staff, thinking that they could effectuate the change on a property, only for it not to happen. And, the longer you wait and the longer you have the wrong staff in place, I mean, everyone should be given an opportunity and allowed to effectuate the change. But if you already know that it's not happening and you're trying to make it happen with them, it's probably not a good position to be in, especially with the asset that you're dealing with, and if it's a distressed asset. So I think one of the things that I've learned from a staffing perspective is evaluate your staff, make sure you have the right people in place, and don't, don't fear making the necessary changes to get to the goal, because there are people out there who can achieve those goals. And then the other side, and I think that's something you learn with experience, and that's something you learn with dealing with people. But from the analytical side, it's just being focused and going back to, the central theme of whatever change you make, follow up on it and make sure that it's actually flowing through correctly onto your financial statement and it's having the impact that you're looking for. A lot of the times, people make changes thinking, oh, this will just happen, without actually following up on the back end to see the impact that it's making. And sometimes you can end up with a surprise that you didn't think was going to happen, or a negative impact, and you could have changed that just by quick adjustments, especially in the income side. As you're changing your pricing, you can lose track of what you're trying to do, being too focused on one item, and then it has a negative impact over time.
Yeah, that makes total sense. And I can tell you that I relate to that tremendously, especially managing property managers that are out of the state of California. Generally speaking, if you feel in your gut that they're not doing a good job, they're usually not, and you can cut them. You
Yeah.
can cut them short pretty quickly.
Well said.
Yeah. So, and I definitely made that mistake earlier in my career as well. Just thinking, okay, like, yeah, he seems like a nice guy, but it's been 2 months and I haven't really seen a change. And it's part of it's laziness. Part of it is just the fact that there's an emotional component there. You want to be able to make people
Correct.
keep their jobs, but at the end of the day, business is business, and the changes have to be made. So that's definitely an interesting perspective. As far as the brighter side of things, what are you most looking forward to going forward? Let's say 5 or 10 years.
Just for me personally, I think what I'm looking forward to is, with our firm expanding this business and our asset management platform. Our strategy over here is, affordable housing. But what I'm really also looking at is opportunities coming back where we currently don't see fundamentals on the conventional side in the California market. And what I'm looking forward to is that time where it does open up that door in that space for us again, where we can get back to conventional in California when the fundamentals make change. Because the exciting part of obviously real estate isn't only the operational side, but it is the creativity that I talked about in the very beginning, which is where you have assets that you can reposition through a rehab or construction, and really have that value add on that side. And I think it's an exciting time for us because we're obviously exposed to a new business line that's been doing really well for us. But I also am excited for the future of seeing those opportunities in California happening again.
Yeah, I agree completely. I think that's a great note to end it on. Nikhil, I really appreciate it. Definitely learned a lot. This is a new topic for me in terms of a lot of these line items. So thanks a lot for coming on the program.
Thank you so much.
For all the listeners out there, I hope you enjoyed this episode. Definitely a unique take on real estate investing. It just goes to show you there are so many ways to add value to property. I am sure there are some major institutional players out there that are completely forgoing this level of detail and leaving a lot of money on the table. And there's tons of opportunities to purchase properties, add to the NOI, and therefore add value to the property. So usually we give the contact information of the guest. Not the case in this instance. Don't contact him. He doesn't want to hear from you, and neither does the company he works for. However, I actually love networking with investors. I've gotten to know a lot of the listeners to the program. It's a great experience. So if you're interested in connecting, definitely don't hesitate to send me an email. That's hunterthompson@cashflowconnections.com. You can also visit me on the site cashflowconnections.com. And I look forward to meeting you. Thanks a lot.